Welcome back to Talk Tickers, the show for the professional investor, where we strip the earnings calls down to the signal. Today is Saturday, January 24, 2026.
Good to be here.
So, if you were watching the tape yesterday, you probably saw a bit of red in a very specific corner of the financials world.
A bit of red is, putting it mildly, the market was absolutely not kind to this report. We're talking about Cohen Steers, ticker CNS.
Right. And the stock closed down, what was it, over 4%?
Over 4% on the session right after the release.
Yeah.
If you just glanced at the ticker, you'd think something was seriously wrong.
But that's why we do this, because this feels like a classic case of what I call headline miss versus managerial swagger.
That's a good way to put it. You have the street, the algorithms punishing the earnings miss. But then you listen to the call, and management is basically claiming the entire macro tide is finally turning in their favor.
It's a huge disconnect. They're making a big bet that the market's about to rotate away from, well, the AI and tech winners we've all been writing.
And rotate back toward real assets. So that's the agenda today. We'll hit the Q4 numbers that caused that sell-off, then dig into the, let's call them hidden positives in the pipeline.
And then we have to break down that aggressive macro call they're making on commodities and real estate.
And of course, we'll wrap with our not financial advice trade idea at the end.
Perfect. So let's start with the damage. What were these headline numbers that spooked the market so much? Was it a complete disaster?
Not a disaster, no, but it was sloppy. Let's be honest. The GAAP EPS, that's earnings per share, came in at 68 cents for Q4.
Okay, and the adjusted number?
The adjusted EPS was 81 cents.
And the street was looking for 82.
Exactly, a penny miss. And then on the top line, revenue was $143.8 million.
Which is actually up year over year, right? About 2.9%.
It is, but consensus was closer to $145 million. So you've got a top line miss and a bottom line miss. And the market we're in right now, you just can't do that. You will get punished.
Okay, so the machines read miss, and they just hit the sell button, standard procedure. But that gap between the GAAP 68 cents and the adjusted 81, that's a pretty wide spread. What's hiding in there?
Yeah, and this is the critical part. This is the signal. The GAAP number was hit by a very specific, one-time, non-recurring expense.
Oh.
It was $10.8 million related to a rights offering for their closed-end fund, UTF.
Okay, hold on. Rights offering for a closed-end fund. Break that down. Why should anyone care that they spent $11 million on that?
Because they have to understand what they bought with that money. A closed-end fund is like the holy grail for an asset manager. It's permanent capital.
Meaning investors can't just pull their money out when the market gets shaky, like in a mutual fund.
Exactly. Once it's in, it's in. They can invest it for the long term without worrying about daily redemptions. And for that $10.8 million cost, they raised $513 million in new permanent assets.
Wow. Okay, that changes the entire story.
It's an incredible ROI. Think about it. You spend $11 million today to get $500 million that you collect fees on for what, the next decade? 2 decades. You make that trade every single day.
But the accounting rules make them book the cost right now in Q4.
Correct. So it drags down the GAAP EPS, makes the print look ugly, and scares the algorithms. But a human investor should see that they just bought a massive future revenue stream.
Which brings us to the flows. Because you can play with adjustments, but you can't fake whether clients are giving you money or taking it away.
And this is where the whole bearish case just kind of falls apart. CNS posted net inflows of $1.2 billion for the quarter.
$1.2 billion in this environment after a huge rate hiking cycle that was supposed to have killed real estate.
It's incredible. They are bucking the trend. This is positive net inflows in 5 of the last 6 quarters. They ended the quarter with $90.5 billion in assets under management. Their competitors are shrinking and they're growing.
So the headline is an earnings miss, but the actual business reality is asset growth.
And that leads directly to the pipeline. Management threw out a number that really jumped out at me. $1.72 billion in the won and unfunded pipeline.
Okay, but pipeline can be a fuzzy word. Sales guys love to talk up their pipeline. Is this real?
This is as real as it gets. Won and unfunded is a specific term. It means the deal is done, the contract is signed, the pension fund or sovereign wealth fund has legally committed the capital.
They just haven't wired the money yet.
It's literally money in transit. And where it's going tells the story. 54% of that pipeline is going into US REIT strategies.
Wait, really? Nearly $1 billion is about to flow into US REITs. We keep hearing commercial real estate is dead.
The big institutions are clearly positioning for a recovery. and another 23% is going into global listed infrastructure.
And are they having to slash fees to get this money?
Not at all. That's the other key. Their effective fee rate is holding stable at around 59 basis points, excluding performance fees.
So they have pricing power. People are willing to pay up for their expertise.
Which is exactly what you want to see. It means clients don't want a passive index that owns all the bad buildings too. They want an active manager to pick the winners.
This is a perfect segue into their macro thesis, because the CIO, John Shea, was not holding back on the call. This wasn't your usual corporate speak.
No, it was a battle cry. He's making a very bold call for a great rotation out of the Mag 7, out of concentrated AI plays.
And he brought some evidence to back it up. I was struck by the gold versus Bitcoin point.
Oh, that was a direct shot. He pointed out that gold is up 250% in the last 2.5 years. It's trading around $4,800 an ounce.
$4,800? It feels like just yesterday people were calling it a boomer rock.
And that was his point. He argued gold proved it isn't obsolete, but he used it as a living indicator. Gold moved first. He thinks real assets, like buildings, are next.
The logic there is pretty compelling. It's all about supply and demand.
It's Econ 101, but for skyscrapers. Construction costs are up 40% since 2020. Steel, labor, concrete, everything.
So it just doesn't make financial sense for a developer to start a new project.
The math is completely broken. You can't get financing. So new supply is just crashing, falling off a cliff.
Which means the buildings that are already built
become incredibly valuable. You have a moat.
Mm-hmm.
If you own the existing apartment building or data center, you have no new competition coming online.
So you get pricing power.
Exactly. It's a scarcity play.
Yeah.
And then you layer on top of that what they see as a new commodity supercycle.
Right. Driven by AI and electrification.
All those data centers need a shocking amount of power. That means copper for wiring, grid upgrades, energy sources. It all plays directly into their core strategies.
It's a powerful narrative. They feel like the macro winds are finally at their back. So how are they capitalizing on this operationally? Are they modernizing?
They have to. And the big push is into active ETFs.
But doesn't that cannibalize their higher fee mutual funds?
They said as much on the call, but their view is that it's necessary. Better to cannibalize yourself than let a competitor do it for you.
You'd rather have the client in your lower fee ETF than in someone else's.
Precisely. And the adoption curve is accelerating. They gave this great little anecdote about their REIT ETF.
Oh, yeah.
It took 159 days, so almost half a year, to get the first $50 million in assets, a real grind.
So that's a slow start.
But it only took about a month to get the last $50 million. So once it hits a certain size, the money starts flowing in much, much faster.
So the plan is to get these things scaled up and then push them globally.
You got it. They're expanding sales teams in Japan, the Middle East, the UK, and their guidance for 2026 shows a lot of discipline.
What are they saying on cost?
Comp ratio holding at 40%, G&A growth in the mid-single digits. The theme was harvesting ROI. They've made the investments. Now it's time to let them pay off.
Okay, let's zoom out. What's the signal here for the broader market?
I think the signal is about inflation, persistence, and diversification. An asset manager is always a leveraged bet on the market, but CNS is a specific bet that inflation sticks around and real assets matter again.
And the conflict in the stock price really shows the tension in the market right now.
It's a perfect example. You have short-term traders selling the stock on a penny EPS miss. But the allocators, the people managing pensions with a 10-year view, are wiring them $1.2 billion.
So it's the traders versus the investors.
And if CNS is right about this rotation, their valuation could re-rate in a big way. If their niche becomes the new market leader, the stock is very cheap.
And if they're wrong?
They're a niche manager getting left behind by the AI bull market. That's the risk. But with gold at 4,800, you have to wonder if they're onto something.
Well, this feels like the perfect time to move to our favorite segment.
Time for the disclaimer.
It is. This is not financial advice. We are not your financial advisors. Please do your own research. This is just for informational and entertainment purposes.
All right, with that out of the way, I'm calling this trade idea the concrete crunch spread.
The concrete crunch spread. I love it. What's the play?
It's a pairs trade. So long and short, it's based entirely on that data point. Construction costs up 40%, new supply is dead.
Okay, what are we long?
You go long-listed REITs and natural resource miners. Specifically, companies with existing cash-flowing assets. You want to own the buildings that are already built and the mines that are already digging.
Because their replacement cost is now sky high, that's their moat.
It's a massive moat. And on the other side, You go short speculative tech and developers.
So you short the companies that need cheap capital and cheap materials to grow.
You short the companies whose business models are broken by higher costs. And if you're feeling spicy, you short the AI hype names that management is betting against.
So you're capturing yield on the long side while betting on valuation compression on the short side.
That's the spread.
Mm-hmm.
But here's the outrageous kicker.
There's always a kicker.
You lever it up.
Of course.
Look, if they're right, if gold goes to $5,000 and new construction stops for 3 years, then existing square footage becomes the new Bitcoin. Think about it. It's the ultimate scarce asset that you can't print more of. You want to be levered long scarcity.
Existing square footage is the new Bitcoin. That's a heck of a take to end on. But based on the data they presented, it's not totally crazy.
The logic follows.
Well, there you have it. CNS misses the headlines, the stock gets hammered, but management is defiant, pointing to a huge pipeline and a changing macro world.
My final thought, keep watching the flows, not just the headlines. That $1.2 billion inflow is the real signal here.
We will see you on the next earnings print. Thanks for listening to Talk Tickers.
See you next time.